Bad loans, the Reserve Bank of India is tightening the screws on banks. A fresh set of prompt corrective action guidelines have been released. P. Sitaram, the CFO of IDBI Bank, joins us on the phone line to talk about that. Mr. Sitaram, good morning and thanks for joining us. What do you make of the fresh guidelines that have been released? And more importantly, do you think that this would mean higher market share gains for banks which have stronger asset quality, like, some of the private sector banks, some of the tier 1 PSU banks?
Yes, the difference between the earlier PCA guidelines and now is that the earlier guidelines had got dated. They are not taken into account the structure of capital as envisaged under Basel III guidelines. So basically the PCA guidelines have been updated for that. If you see that with the emphasis on capital monitoring is still the same, in the sense that there were 3-level thresholds in the earlier PCA guidelines, and these continue. The emphasis is on CET1, which is as it should be, because the Basel III guidelines have moved on from a total capital adequacy to a CET1 focus.
Mr. Sitaram, there is a new menu of regulations that RBI has put in. You have to give up to them a timetable of how you will recover. You will not get into high-cost derivatives. You will not get into high-cost deposits. There is this regular monitoring. You can't declare dividends. What will all this mean? How does life change for you?
Yes, if you look at the earlier guidelines we shared, which had come out in 2002, they had a very similar menu. There were structured actions and there were discretionary actions. So such sort of prescriptions continue under these guidelines. Even earlier, we had this RBI discretion on non-declaration of dividend, on other actions also. So it's not something that is new. What is new is that the emphasis has been shifted to CET1 in tune with the changed Basel guidelines. And secondly, they brought in leverage ratio as a measure which was not there earlier. That's also a new measure which has come in as part of a commitment to the Basel III guidelines. So this is an update of the earlier PCA guidelines.
But don't you have to, I mean, the manner in which the guidelines are worded, it seems to indicate that you all will have to regularly meet the supervision department and adhere to some, give them targets and adhere to those targets.
Which was very much there even earlier.
But
the quarterly meetings, once a bank comes under PCA, then the frequent submission of information, monitoring against the targets which have been set by the bank. All that was there even earlier.
Yeah, but you were not under PCA, no, Mr. Sitaram. 13 banks were not under PCA. I'm just asking you, once you come under PCA, how will life change?
No, yeah, I mean, what I'm saying.
Are you saying that there is no difference between what was happening to these 13 banks before Thursday and after Thursday?
No, we are speaking about the content of the PCA guidelines.
No, I'm asking you the impact on your bank. How will your own behavior change?
It's same. See, as far as bank-specific issues are concerned, each bank would have to address it in its own way. What the PCA guidelines now lay down is that you have to monitor your CET1 quite closely, and the triggers will be threefold as far as CET1 is concerned, whereas they were threefold as vis-a-vis the total CRAR. So that's the change. The total CRAR is still very much there in the capital, but the emphasis is much more on the core part, that is the CET1. I mean, that's what banks would need to keep monitoring on that. The second is, of course, the leverage, which is a new measure which has come in and which was not there under the earlier PCA guidelines. Therefore, banks would have to keep track of how their leverage is behaving.
Okay, so all of these guidelines put together, do you think that this will help speed up resolution of the stressed assets in the sector?
This entire PCA is focused on the banks. Okay, it's not about the resolution of the stressed assets, which is a separate debate altogether. The impact of those stressed assets on the bank's balance sheet is what is being monitored through the PCA.
Okay. Well, they are going to monitor recovery as well. So, would you therefore expect these 13 banks to have to speed up their recovery?
If you look at the earlier PCA guidelines, again the same thing was there, that in case a bank fell under a PCA regime, the emphasis would be on recovery of the
Mr.
NPAs.
Sitaram, you're missing the point. I'm asking you, until now, these 13 banks were not under PCA. Now they are under PCA. So, therefore, what will they have to do differently?
No, what I'm saying is that if any bank would have come under a PCA under the new guidelines, I would say that they would be coming under PCA even under the earlier guidelines. If you look at total CRAR is very much there. Okay, the net NPA, the percentage has been brought down, the threshold. So there are 3 thresholds. The net NPA thresholds have been brought down. To that extent, yes. Okay. But I would say that the net NPA, if it reaches those levels of even threshold level 2, by then the CET1 would have been impacted. Okay. So ultimately, it's the CET1 which will have a direct impact of all this. And monitoring of that would have happened even under the earlier PCA regime through the total CRAR. So any bank which will fall under a PCA, under the new guideline, I would assume that more or less they would be have been covered under the PCA regime, even under the old guidelines.
All right, Mr. Sitaram.